the market moves in a lot of stocks that are exposed to the domestic environment, they've been significant and in a lot of places overdone. Now, one example of this is Motorcycle Holdings, the motorcycle retailer. The company's taken advantage of a strong COVID period by reducing the debt on its balance sheet, by making a handful of acquisitions, generally improving the business. It started trading the year at about 10 times earnings and actually derated quite sharply to 6 times by the end of the financial year.
That's right, Chef. Another very good example is 7 West Media, the TV channel. If you look back in December, the company was trading at 6 or 7 times earnings. Since then, they delivered 2 earnings upgrades, and yet the stock closed the fiscal year in June trading at around 4 times earnings. And this is because the market is getting increasingly more concerned about the health of the advertising cycle in Australia.
Viva Group, the gyms operator, it's another really good example of this. They had a very poor COVID as gyms were locked down, but is now starting to come out of it and is beating their own expectations around revenue returning and around margins. But this post-lockdown winner was also hit quite hard over the last 6 months, derating from about an 18 times PE to 8 times.
Another good case in point is Media, the out-of-home advertising company that forms a duopoly in Australia with JCDecaux. If you look at their share price, it's down 30% from December to June, and that's with earnings forecasts that are basically unchanged. Again, so that represents a compression in the earnings multiple from 17 times back in December to 11 times now. And again, this is a reflection of the creeping worries about the outlook for advertising. As you can see with these 4 companies, they are all exposed to deteriorating economic conditions, but the share prices are already discounting an overly harsh environment that may or may not happen in the future.